So, first important thing is to set goals for yourself. Nothing in life is achieved if you don't have a goal. As I say, then it's just a dream at the end of the day. So it will vary from person to person in terms of what you want to achieve. And it's always very valuable to say, this is how much I want, and how am I going to get there? What steps do I have to take to get there? And it's part of your planning process. So goals, and this is just an acronym that's often used, that goals are SMART goals. They are specific, so you need to know what the goal actually is. They must be measurable. So you must know when you've got there. Otherwise, what's the point? They must be achievable. So there's no point in saying, I want to go on a cruise at the end of next year that's going to cost 50,000 Rand, and I need to put away 5,000 Rand a month. But meanwhile, I actually can't afford to put away 5,000 Rand a month. So the goal has to be achievable. They must be realistic. So it must be something that actually will add value to your life and something that you will value still in future going forward. And they must be timeless. So there must be a time attached to that goal, and again a realistic time frame in which you will achieve it. When we set goals, we often may find that the goalpost will change. Things don't always perform the way we expect them to perform. So if you've got a goal, and I'm talking financial goals, if you've got a goal and you know you need to save or invest X amount per month to get there, you're basing that on a certain return, a certain growth in your investment. If that changes, if that doesn't perform according to what you expected, you may have to increase that goal, move that goal out a bit further, or change that goal. But the important thing is to have a goal. So otherwise you won't actually know when you actually get there. You then need to have a roadmap, you need to have a plan, and I'm going to talk a bit about planning now in a few minutes, financial planning, what that is and how that plan can look. And then you need to actually measure your progress in life. So I'm not going to talk in a lot of detail. In the book there's actually a section on net worth, and there's a worksheet. You can figure out your net worth. But is wealth and money the same thing, do you think? No, it isn't. Money is money. Money is cash. Money is something we consume and use. Your wealth is how you are growing. You're building up your wealth over time. And you measure that through your net worth. Your net worth is quite simply what you own, or everything that you own, that you have, minus what you owe. And as you go through time, what you own, what you possess, should increase in relation to what you owe to people. If your debts are spiraling out of control, you may find that actually your net worth is going in the wrong direction. Often very young people have got a very low net worth because they're starting out. They may have study loans, so they're starting out. They don't actually own very much, so they've got a very low net worth. But as you work and as you build up assets, you will build up your net worth. Just another point in terms of that, use your income to build your wealth. We don't think about it. We say to ourselves, doesn't matter, as I said earlier, we can do it next year, next month, whatever, but use that income. That income of yours is valuable, because when you don't have it one day, you haven't got anything to build wealth with. So use your income wisely. So have a roadmap, know where you're going, set those goals, put a plan in place, and then measure your progress. So some goals may be short term. Okay, maybe I want to go on a cruise end of next year. Some goals maybe, I'm 35 now, at 50 I want to have enough money, or at 55 I want to have enough money so that I can stop working. Okay, goals will differ, and they will have different implications and different ways of achieving them. So what is your financial plan? When we talk about financial planning, and what is a financial plan? It is a blueprint. It is a plan as to how to get there. So if you were going to build onto your house, for instance, or renovate part of your property or house, you wouldn't just go to Builder's Warehouse and buy a whole lot of stuff and sort of figure it out as you go along, right? Hopefully not. It's the same with your planning. You're not going to just stumble along and think, I'm going to do this now and do that there. There's great value in having it properly documented in a plan so that you know where you're going and you know where your priorities are. So what are the elements that would be in a financial plan? You need to have an emergency fund. So when we speak about this financial foundation that I spoke about, this is it. Making sure all these boxes are ticked. So firstly, an emergency fund. If something goes wrong, you must have some cash. And that's extra money you're keeping in a separate bank account. It's not the amount of credit you have available on your credit card. That's not an emergency fund. Then you need to protect your income. Remember I said right at the beginning, we give our skills and our time in exchange for money that buys our lifestyle. if something happened that I could no longer generate that money, if I think of myself as a business, which we all are, if I could no longer generate that money, how would I fund my lifestyle? And that's what protecting your income is about. And I'm not going to talk about that in too much detail, but it's really in terms of if you got ill, if you died, or if you became disabled. All right, if you died, obviously it wouldn't bother you because you wouldn't be around, but you have other people that are dependent upon you.
And would retrenchment fall under that?
Yes, it would. Yes, very much so. Retrenchment as well, protecting your income. Yeah. So it's making sure that you actually have that income no matter what happens. And then obviously you reach a point, probably when you say, they'll use the word retire again, but when you retire, when you stop formal work, you don't need to protect that income anymore because you have the pot of money, the capital that you're living with. Right. So that's something also one needs to consider too as you get older. Your financial needs change. You may not need to have that insurance in place, that income protection, or even that life cover necessarily that you needed when you were younger. Okay, so financial planning and managing your money is a live process. It's ongoing. It keeps being reviewed because life changes, and as life changes, you need to change your planning and you need to adapt as you go along. So we need to invest for tomorrow is another part of your plan, and we've spoken a bit about that, but investing, and the last module I'm going to talk about is how investing works. So obviously old age, we've spoken about old age, and we've got dreams and goals and all kinds of things we want to achieve in life. It might just be buying a house, it might actually be going overseas, it might be sending our child to university one day. Whatever it is, we all have dreams and goals. Then it's short-term assurance, that's your car and your household. And as I said earlier, shop around there for the best deals. Don't just accept whatever has been given to you, and look beyond those marketing messages. Medical cover, always a good idea to belong to a medical scheme, particularly for hospital. Okay, medical expenses are frighteningly expensive in South Africa, hospital costs. And then, of course, underpinning all of that is a will. So how many of us in this room have got a valid will? Geez, that's quite good.
Yeah,
That's quite good, yeah.
Normally it isn't one side.
Not at all. Okay, so if you've got a will, if you haven't looked at it for the last year, please find it and go look at it. I worked with a man, colleague of mine, and we both worked in the financial services industry, and he told me one day he hadn't looked at his will for 20 years. So that's ridiculous because life changes all the time. You acquire new assets, your situation changes, you marry people, you divorce people, you whatever. Things change. Make sure that your will is up to date. So at least once a year, just go and have a look at it. If you don't have a will, please get one drawn up. Okay. It's not that you're going to die, but you don't want people to say, wow, she was great when she was alive, but look at the mess she left when she died. Okay. You want to make sure everything's tied up and you leave a legacy for other people, that you leave this earth and you leave things neatly tied up and sorted out. Also, if you don't have a will and you've got dependents, for those few that haven't got a will, your dependents will be in a very bad situation, because everything will be frozen for up to 2 years, and the state will then administer that will, an appointee of the state, and your assets will go to whoever they deem, in terms of interstate law, whoever they deem them to go to. Okay, so it can leave your dependents in a very vulnerable position. Okay, so the will. So that's really, in essence, what your financial plan should entail. Should cover all of those areas. And Rome wasn't built in a day. So maybe you've got some and you haven't got others, and that's okay. Take it one step at a time, but take the decision to actually put it in place and to start ticking off those boxes. Okay, when we talk about advice, remember it's easy. Do you know what the recipe is? Spend less than you earn and invest the rest. That's as simple as it is. Okay, so I managed to fill, I think, 200 pages saying all of that. But the book is about two things. The first half is about finding the money, which we've spoken quite a bit about, and the second half is about how to invest it, understanding investment. Because as I said at the beginning, a lot of us operate from a position of fear. We don't understand this world. We don't quite know if we've been told the right thing or the wrong thing, and knowledge is power. But also knowledge is power means nothing unless you put it into action. So you've got to know what you're doing, empower yourself financially. That's as simple as it is. Okay, and there's a lot of information out there. Teach yourself bit by bit. So when it comes to the world of investing, the kind of things that you need to consider when you are looking at where and how to invest, because there's so many different places to invest, right? There really is a range. We need to know why you want to invest. So we've done that, the goal. What is the point of investing? Why do you want to do it? By when do you need it? The timing thing. How much risk can I afford to take? So the old rule of thumb, of course, is the more risk you take, the greater the return. But some of us are like very risk averse. Because there is so much emotion attached to money, risk is something that goes to the heart of us. We don't want to lose. So you need to understand how much risk you can take and are comfortable taking. Where are you going to invest? $1 million question, and I'll talk a bit about the different options now. And then cost versus return. I wanted to mention that because there's a big battle in the financial services industry. You've probably seen the ads. Lowest cost ever. Lowest cost ever. See-through investing, or whatever they call themselves. Transparent and all the rest of it. Costs are an issue. You unfortunately do have to pay people to manage your money. That's how it works. And you've got to pay people to advise you. No advisor is going to do that job for free, because then they're not worth anything. Okay? People have time, expertise that they put in. So there are costs involved. Just be careful of falling for the lowest cost options, because they may not have the best returns at the end of the day. When you're investing, you've got your return minus your cost is what you're going to end up with, right? Simple, you can understand that. Your return minus whatever it's cost you, your net return. You could find that the cost may be quite low, but actually the returns aren't so great. So you end up with less, and if you went somewhere else that perhaps had a much better return, slightly higher cost, but your net return is still good. Okay, so just be careful of that. Again, the sort of promise of lower costs, because lower cost doesn't necessarily mean at the end of the day you as the consumer or the investor are going to be getting the best deal. Market. And did you know that the JSE has been the best performing stock exchange worldwide since 1900? The best performing worldwide. They measured this by saying if you put like R1 into the JSE 1900 and R1 onto the New York Stock Exchange and wherever, you would have had a best return on the JSE, which is phenomenal. But it's incredibly risky, like this client of mine now that I'm busy acquiring, who's lost 600,000 Rand because she has a share portfolio that her brother's administering. Very, very risky, because you're right there at the coalface. You as the investor are making decisions. Do I buy this? Do I sell that? At the very other end of the spectrum, at the lowest end is the bank account. Okay, our safe spot. You go to the bank, they tell you, I will pay you 4 or 5% interest or whatever it is, so you know what you're getting, and we promise we'll give back your capital at the end. You'll get your money back. So there's virtually no risk for you, unless the bank collapses, but the African bank was the closest I think that came to it about 2 years ago. So the bank is safe. So those are the two ends of the extreme, because yeah, you can lose all your money overnight. You can literally put it in. Does everybody understand what a share is? Share is a piece of a company. So let's say this table is a company and they want to raise money. They will then go and they will say, fine, we are going to sell pieces of our company off to the public because we want to raise money. And they then have to register, have to list it through the Johannesburg Stock Exchange. That regulates it. And they go as this company and they list on the Johannesburg Stock Exchange, and people can buy slices of the company, and those are the shares that you buy. So you, as a shareholder, you own a part of that company, which is quite cool actually if you think about it. But if that company mismanages itself, you can lose everything. There's no guarantee, no promise. Okay. Huh? Start off, like start off the end of last year. So those are the two ends of the scale, of the risk spectrum. In between, there's another even more risky one actually before I talk about in between. Okay, this one here. Very, very high risk. A lot of people made a lot of money last year. A lot of people lost money last year. And I'm not going to debate it, go into the ins and outs. Safe to say that the biggest problem with Bitcoin is that we don't understand why it has value. Coming back to this table is a company. We all own a slice of this business. When this business does well, they pay profits, they give us dividends, okay, because we own a piece of it. This company makes something, it does something, it creates value, it's not just a shell. So we understand why this company has value. We understand why shareholders, our shares cost X amount. We understand why they pay us dividends. We understand how this works. With Bitcoin, we don't. Yes, it's a binary system, it's a means of payment, all of that stuff, that's good. But in terms of the price, why was the price climbing last year? Why did it drop? There's too many unknowns, there's too many things we don't understand. I'm not saying it's completely wrong, I don't discount it. I think what it has done is it's shaken up the financial services industry, which they need to shake up. A bunch of stodgy old people always say we know better. It's challenging it, but you need to be very, very careful. So when people say to me, shall I put my money in Bitcoin? I say, you know what? By all means, but put money in there that you can afford to lose. Okay, bit of mad money. I don't know if anyone's got money they can afford to lose, but it's not the basis for a long-term financial plan. But if you want to experiment, it's like buying the lotto or going to play the horses on a Saturday afternoon at Kenilworth Racecourse. Put a bit of money into Bitcoin. So, okay, then there's real estate investment trusts, which are property. So we always say, oh, we must invest in property. So there are two ways of investing in property. The one is you can buy yourself a rental property and you can rent it out. So you can use the bank's money, very clever, use the bank's money to buy a property and you then rent it out and you get income, and as the property appreciates, you'll have capital appreciation. There's a whole lot of ins and outs around that though. You need to be quite cautious, and there's a whole lot of stuff. I'm not going to go into detail there. It's not for the faint-hearted. Not everybody wants to be a landlord either. Some people don't like all that responsibility. So if you want to be in property, but you don't want all of that responsibility, you can invest in a real estate investment trust. What is that? That is a property unit trust. So they are unit trusts made up of companies like, they administer buildings, commercial buildings, Aspire and, I can't think of the others now, but they administer and they run buildings. Redefine you to actually get access to property, but without getting your hands dirty, such as here. Okay. So people are always like, oh, property, property, property. So the last sort of 3 to 5 years, there's been quite the results on sterling. So it all depends on your timeline. If it's a longer term, 10, 15 years, they've delivered good growth, but shorter term, not so good. So again, it also depends where, your timeline depends on where you invest. And in terms of risk, I mean, these are high, so we're kind of moving slightly more towards the medium risk. And I put rental property on the lower end of the scale because property is quite solid, all right, especially in Cape Town. There are other parts of the country where it isn't as great. There's perhaps not that capital appreciation. It's interesting though, what's happened in Cape Town over the last about 6 months or so has become a tenant's market. Properties are standing empty, landlords are having to drop their rent, and so the power has kind of shifted. We used to see this huge surge of people buying investment properties. But Airbnb, a lot of people went onto the Airbnb thing, a lot of them didn't work out, so they've turned that into long-term rentals, which I think has had an impact on the fact that there's a lot of rental stock available. And so it is very much a tenant's market. It's one of the things I do on the side. I dabble a bit in that too, and I've seen many cases where we have property that's, let's say, 15,000 and the landlord ends up accepting 12 because it's better to have 12 than to have 15 and it's empty for 6 months. So as I say, this is a space that one needs to be very careful of. Tax-free savings, we've all heard of those, huh? Okay, you can put up to 33,000 Rand a year into tax-free savings. Also medium risk. I'm not a great fan of tax-free savings, so that's my personal belief, because I think there's some returns one can get better elsewhere. From what I can see, they're delivering about 8 or 8.5%, which is not bad, but I do think there are other places where one can get a better return, but the growth is tax-free. So it all depends on your tax situation, how much tax you pay, and I'm not going to talk about tax, but it also depends on that. But they are an option for people, and not necessarily a bad thing. One just needs to have a look. Really, if there would be no tax implications and you're investing in a really good unit trust, because you are under the threshold for interest and so on, there's no reason to go into tax-free savings. Okay, but it's, as I say, that's all part of the discussion you would have around where to invest. Bonds are also quite low risk. Bonds are basically government or company bonds. So what they do is they lend money to institutions and to investors, and they offer a fixed interest rate, and at the end of the time they actually buy back that bond. We don't deal with bonds as individual investors. There is a bond market that is part of the JSE, and all these clever people that sit in the big financial services companies, they buy and sell and trade bonds as part of the investment portfolio that they manage. Anybody got Krugerrands? Okay, cool. Krugerrand's pretty safe down here, low risk. They link to the gold price, so Krugerrands are not affected by any other currency movements or inflation or anything like that. They link to the gold price. So traditionally Krugerrands have always been a nice little thing to have. I always think it's a nice thing to give if a child is born. Give them a quarter Krugerrand or whatever, just instead of buying stuff, you know what I mean? Give them that so that maybe when they're 20 or 21, it's something that's worthwhile. Then there's art, and these are the alternative investments. So I just must say that actually what I've covered here, basically these are all in the financial markets. So the bulk of investments are in the financial markets. You then get the other ones, the Krugerrands, which is alternative art, if you know what you're doing. There's apparently a great movement in South Africa around sort of Africana, traditional African pieces of art. There's diamonds, if you know what you're doing there. And then, okay, so that's it. Yeah, and then there's just my statement again about doubling your money if you're investing in equities. It will take you 9 years. So if you want to make money long term, the simplest way is to do something that's linked to the stock market, is an equity linked investment. And as I say, there are a variety of ways to actually reach them, all with different risk profiles and a number of factors that come into play. I know this is a huge amount of information on one slide, but does it make it a little bit clearer in terms of investment options? Okay, because this could be a workshop on its own, just investment options and tax implications. And just to tell you and show you why equities work so well, and this is the only graph I'm using, which I think is rather nice, because I don't like graphs, people run away with graphs. This is over a 20-year period, okay? This is the JSE All Share Index, which is an index of a certain set of shares that they track. And you can see what it's done over a 20-year period, from December 1997 till December 2017. You see the volatility, okay? So when you talk about risk and return, if you're in the short term, if you're investing for 2 or 3 years, you can't afford to take such a risk. Because let's say you're investing here and you need your money here. You see that? You can't afford to take the risk of all these ups and downs. But if you can invest longer term, you see the trend is upwards. Okay, so that's why there's this trade-off between risk and return. Shorter, you can't take much risk. So they always say when people are close to retirement, within a few years of retirement, they should switch to less risky investments. Because you don't want to be forced. The day you want to retire now and take your money, you don't want to be at this low point or at that low point. Okay, you want to actually be somewhere where your money is safer. So I think I can't say that any stronger. If you want to grow your money long term, it needs to be linked to the equity market. And then just a warning about Ponzi schemes. Okay, we all say, oh yeah, you know what I mean, like, oh yeah, who's so stupid? Millions of us are so stupid over and over and over again. It happens all the time. You know why? Because the con men get cleverer and cleverer. But these are the things, the red lights, the red flags that you must watch out for. Abnormally high returns. So inflation at the moment in South Africa, I think, is at about 4.5%. I saw the other day, something phenomenal. It's actually dropped. So you can expect to maybe get, if you're lucky, 7, 8, 9. There's there's 1 or 2 that are doing really well. But if they're promising you're going to double your money, it's too good to be true. Okay, red flag. You cannot double your money. They tell you guaranteed returns. You will get so much money. Definitely, it's not possible. Vague business models. Do you understand how they make their money? Do you understand it? I remember going a good few years ago with a friend of mine. No, I must come to this presentation. It's fabulous, fabulous presentation. I said, what's it about? No, we went to this place in Pinelands, and there was these people explaining this investment opportunity. Something to do with, there was a lot of pictures of holiday resorts and stuff. But I didn't know what it was, and afterwards, I tried to understand what it was, and nobody could explain to me what it was. And I mean, I'm not a stupid person, and I should be able to understand, but I didn't, so I left it. I didn't go there. So you must be able to understand it. This is the classic. The more people you recruit, the better, more money you make. Okay, that's your pyramid. That's why it's called a pyramid, because you start out, okay? Then you recruit a few more people and you get a percentage of what they've got. Then there's a few more people you recruit and they get a percentage and you get a percentage. And so it goes. So by the time you've the thing has grown, you're getting money from all of these levels. The more people you bring in, the more you make. There's nothing being manufactured, there's nothing being made, there's no reason for money to be generated except new people are coming in. And did you know that Charles Ponzi was a guy in New York who did a mail fraud scheme in like 1918, around there? Because in those days, you bought a stamp for the value of whatever, it was like a personalized stamp for the value of the parcel you were sending or the envelope. And he figured out a way of actually like just doing a stamp that was a certain price, and then when it came back he got the refund of that, the difference. He ended up fabulously wealthy and then fabulously poor in jail at the end. But that was who Ponzi was named after, because he came up with a scheme how to make money out of nothing. Why does it collapse? It collapses because eventually not enough people are coming in at the bottom. So it cannot feed itself, so it just collapses flat. Okay. And then there's a pressure to reinvest. So they say, don't take your money, but keep putting your money back in. Yeah. So just be wary, okay, please. Our money is hard earned enough. Just be wary. So in summary, every woman can be a smart woman. So those are the key points. She puts herself in the driving seat, makes smart choices, has a plan, and keeps track of her progress, and then she invests for success. Okay, that is really, in essence, the nutshell of it. And I always like this quote by M. Scott Peck from The Road Less Traveled. I read this book many years ago, and I don't know if anybody else has read it, Road Less Traveled. In fact, when I read it the first time, it was the days before smartphones, we just had SMSs. And I saw this and I typed it out as an SMS and saved it. Remember those days you could draft SMSs? Yeah. Did one of that with this quote. And I've used it all the years because for me it's so incredibly powerful. He says the entirety of adult life is a series of personal choices and decisions. If we can accept this totally, we become free people. If we don't accept it, we will forever feel victims. So as women in life, we so often utter those 4 little words. You know what those 4 little words are? It's not my fault. Okay? It's somebody else's fault that I'm in this position. And that is the most disempowering thing we can do to ourselves. Because we make decisions at every stage in our life. You made a decision to come here this morning for a reason. You've hopefully picked up some information, and hopefully you will go and do something different when you leave here. If you do nothing different, that's your own endeavor. That's cool, that's your decision. If something goes wrong in the future, or you find yourself in 10 years still you haven't started investing, don't blame anybody, because you have information and you have choices. And we make choices at so many different, we decide what to wear in the morning, we decide what job to do, who to get married, if we're going to have children or not. Some are big decisions, some are small decisions, but each decision has a consequence. And if we accept those consequences, we don't feel victims. We are not victims. We are empowering ourselves.